0.360. A correlation of 0.360 means that 36% of the variance in price was explained by the variance in earnings. With stocks held for 5 years, the correlation ranged from 0.374 to 0.599. In a 10-year holding period, the correlation increased to a range of 0.593 to 0.695. For the entire 18-year period, the correlation between earnings and share price is 0.688, a significantly meaningful relationship. This bears out Buffett's thesis that a strong business will eventually command a strong price, given enough time. He cautions, though, that the translation of earnings into share price is both uneven and unpredictable. Although the relationship between earnings and price strengthens over time, it is not always prescient. While market values track business values quite well over long periods, Buffett notes, in any given year the relationship can gyrate capriciously. 65 years ago, Ben Graham gave us the same lesson. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. It is clear that Buffett is in no hurry to have the market affirm what he already believes is true. The speed at which a business's success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate, he says. In fact, delayed recognition can be an advantage. It may give us the chance to buy more of a good thing at a bargain price. Look through earnings. To help shareholders appreciate the value of Berkshire Hathaway's large common stock investments, Buffett coined the term look-through earnings. Berkshire's look-through earnings are made up of the operating earnings of its consolidated businesses, its subsidiaries, the retained earnings of its large common stock investments, and an allowance for the tax that Berkshire would have had to pay if the retained earnings were actually paid out. Retained earnings are the portion of a company's annual earnings that are not distributed to shareholders in the form of dividends, but are reinvested back into the company. Over the years, Berkshire's share of retained earnings from its large common stock holdings, including Coca-Cola, Federal Home Loan Mortgage, Gillette, the Washington Post Company, and others, has been significant. In 1997, the figure was $743 million. Now, under generally accepted accounting rules, GAAP, Berkshire can't report its share of retained earnings in its income statement, even though, as Buffett points out, the retained earnings have obvious value. The notion of look-through earnings was originally devised for Berkshire's shareholders, but it also represents an important lesson for focus investors who seek a way to understand the value of their portfolio when, as will happen from time to time, share prices disengage from underlying economics. The goal of each investor, says Buffett, should be to create a portfolio, in effect a company, that will deliver him or her the highest possible look-through earnings a decade or so from now. According to Buffett, since 1965, the year Buffett took control of Berkshire Hathaway, the company's look-through earnings have grown at almost the identical rate of the market value of its securities. However, the two have not always moved in lockstep. There have been many occasions when earnings moved ahead of prices, when Mr. Market was unduly depressed, and other times prices have moved far ahead of earnings, when Mr. Market is uncontrollably enthused. What is important to remember is that the relationship works over time. An approach of this kind, counsels Buffett, will force the investor to think about long-term business prospects rather than short-term market prospects, a perspective likely to improve results. Buffett's measuring stick. When Buffett considers adding an investment, he first looks at what he already owns to see whether the new purchase is any better. What Berkshire owns today is an economic measuring stick used to compare possible acquisitions. What Buffett is saying is something very useful to practically any investor, stresses Charlie Munger. For an ordinary individual, the best thing you already have should be your measuring stick. What happens next is one of the most critical but widely overlooked secrets to increasing the value of your portfolio. If the new thing you are considering purchasing is not better than what you already know is available, says Charlie, then it hasn't met your threshold. This screens out 99% of what you see. You already have at your disposal, with what you now own, an economic benchmark, a measuring stick. You can define your own personal economic benchmark in several different ways. Look through earnings, return on equity, or margin of safety, for example. When you buy or sell a company in your portfolio, you have either raised or lowered your economic benchmark. The job of a portfolio manager, who is a long-term owner of securities and believes future stock prices eventually match with underlying economics, and the manager might well be you, is to find ways to raise the benchmark. That's an enormous thought conserver, says Munger, and it's not taught at the business schools by and large. If you step back and think for a moment, the Standard & Poor's 500 Index is a measuring stick. It is made up of 500 companies, each with its own economic return. To outperform the Standard & Poor's 500 Index over time, to raise that benchmark, we have to assemble and manage a portfolio of companies whose economics are superior to the average weighted economics of the index. The process of managing such a portfolio is what this audio is all about. Tom Murphy, who ran Capital Cities ABC before merging it with the Walt Disney Company, understood economic benchmarks perfectly. Inside Cap Cities was a group of media companies that on a combined weighted basis produced an economic return for shareholders. Murphy knew that to increase the value of Cap Cities, he had to find companies that could raise the existing economic benchmark. The job of the manager, Murphy once said, is not to find ways to make the train longer, but to find ways to make it run faster. You should not be lulled into thinking that just because a focused portfolio lags the stock market on a price basis from time to time, you are excused from the ongoing responsibility of performance scrutiny. With the advent of economic benchmarks, you will, despite the vagaries of the market, still have to defend your individual picks. Granted, a focused manager should not become a slave to the stock market's whims, but you should always be acutely aware of all economic stirrings of the companies in your portfolio. After all, if a focused manager hasn't got the economics right in the portfolio, it is unlikely Mr. Market, to whom you will be reintroduced in Chapter 7, will ever find an occasion to reward the selections. 2 good reasons to move like a sloth. Focus investing is necessarily a long-term approach to investing. If we were to ask Buffett what he considers an ideal holding period, he would answer, forever, so long as the company continues to generate above-average economics and management allocates the earnings of the company in a rational manner. Inactivity strikes us as intelligent behavior, he explains. Neither we nor most business managers would dream of feverishly trading highly profitable subsidiaries because a small move in the Federal Reserve's discount rate was predicted, or because some Wall Street pundit has reversed his views on the market. Why then should we behave differently with our minority positions in wonderful businesses? Of course, if you own a lousy company, you require turnover because without it you end up owning long-term the economics of a subpar business. But if you own a superior company, the last thing you want to do is to sell it. When carried out capably, a low-turnover investment strategy will often result in its practitioner owning a few securities that will come to represent a very large portion of his portfolio, explains Buffett. This investor would get a similar result if he followed a policy of purchasing an interest in, say, 20% of the future earnings of a number of outstanding college basketball stars. A handful of these would go on to achieve NBA stardom, and the investor's take from them would soon dominate his royalty stream. To suggest that this investor should sell off portions of his most successful investments simply because they have come to dominate his portfolio is akin to suggesting that the Bulls trade Michael Jordan because he has become so important to the team. This sloth-like approach to portfolio management may appear quirky to those accustomed to actively buying and selling stocks on a regular basis. But it does have 2 important economic benefits, in addition to growing capital at an above-average rate. 1. It works to reduce transaction costs. 2. It increases after-tax returns. Each advantage by itself is extremely valuable. Their combined benefit is enormous. Reduced transaction costs. On average, mutual funds generate between 100% and 200% turnover ratios each year. The turnover ratio describes the amount of activity in a portfolio. For example, If a portfolio manager sells and rebuys all the stocks in the portfolio once a year, the turnover ratio is 100%. Sell and rebuy twice a year, and you have a 200% turnover. If, on the other hand, a manager sells and rebuys only 10% of the portfolio in a year, implying an average 10-year holding period, the turnover ratio is a lowly 10%. In a review of 3,560 domestic stock funds, Morningstar, the Chicago-based researcher of mutual funds, discovered that funds with low turnover ratios generated superior returns compared to funds with higher turnover ratios. The Morningstar study found that over a 10-year period, funds with turnover ratios of less than 20% were able to achieve returns 14% higher than funds with turnover rates of more than 100%. This is one of those common-sense dynamics that is so obvious it is easily overlooked. The problem with high turnover is that all that trading adds brokerage costs to the fund, which works to lower your net returns. After-tax returns. Low turnover funds also have another important economic advantage: the positive effect of postponing capital gains tax. Ironically, that which is supposed to increase your returns in a fund, namely turnover, also increases your current tax liability. When a manager sells a stock and replaces it with another stock, the belief is that the move will enhance the fund's return. But selling a stock means that a capital gain is realized, and so each new pick has the anchor of outperforming the capital gains tax associated with the stock it replaced. Of course, if you own an individual retirement account or a 401k plan, you do not pay taxes on their earnings or gain. But if you own a mutual fund in your personal account, any realized capital gains generated in the fund will be passed down to shareholders, triggering a capital gains tax for you. Obviously, the more stocks are sold from the fund, the more tax liability you may face. Even when the year-end performance of a mutual fund shows a competitive return, by the time you have paid the taxes on the gains realized, your net after-tax return may very well be below average. Savvy shareholders are starting to ask whether the return provided by their actively managed fund is high enough to pay the taxes owed and still generate a return higher than the index funds, which are by their nature very tax efficient. Except in the case of non-taxable accounts, taxes are the biggest expense that investors face, higher than brokerage commissions, and often higher than the expense ratio of running a fund. In fact, taxes have become one of the principal reasons why funds generate poor returns. That is the bad news, according to money managers Robert Jeffrey and Robert Arnott. They are the authors of Is Your Alpha Big Enough to Cover Its Taxes?, an article that appeared in the well-respected Journal of Portfolio Management and generated extensive discussion in the investment world. The good news, they write, is that there are trading strategies that can minimize these typically overlooked tax consequences. In a nutshell, the key strategy involves another of those common-sense notions that is often underappreciated: the enormous value of the unrealized gain. When a stock appreciates in price but is not sold, the increase in value is unrealized gain. No capital gains tax is owed until the stock is sold. If you leave the gain in place, your money compounds more forcefully. Overall, investors have too often underestimated the enormous value of this unrealized gain, what Buffett calls an interest-free loan from the Treasury. To make his point, Buffett asks us to imagine what happens if you buy a $1 investment that doubles in price each year. If you sell the investment at the end of the first year, you would have a net gain of 66 cents, assuming you're in the 34% tax bracket. Now, you reinvest the $1.66, and it doubles in value by year end. If the investment continues to double each year, and you continue to sell, pay the tax, and reinvest the proceeds, at the end of 20 years, you would have a net gain of $25,200 after paying taxes of $13,000. If, on the other hand, you purchased a $1 investment that doubled each year and was not sold until the end of 20 years, you would gain $692,000 after paying taxes of approximately $356,000. A cold look at the numbers makes a couple of observations clear. You end up with a great deal more profit if you don't take your gain each year, but just let the money compound. At the same time, your lump sum tax bill at the end of 20 years will take your breath away. That may be one reason people seem to instinctively feel it's better to convert the gain each year and thereby keep the taxes under control. What they fail to appreciate is the truly awesome difference in return that they are missing out on. For their article, Jeffrey and Arnott calculated the point at which turnover begins to negatively impact the portfolio. The answer, surprisingly, is counterintuitive. The greatest tax damage to the portfolio occurs at the outset of turnover and then diminishes as turnover increases. Jeffrey and Arnott write, conventional wisdom thinks of any turnover in the range of 1% to 25% as categorically low and inconsequential, and of anything greater than 50% as being high and presumably of considerable consequence. The reality is just the opposite. The Jeffrey Arnott study shows that at a 25% turnover ratio, the portfolio incurs 80% of the taxes that would be generated by a portfolio turnover ratio of 100%. They conclude that it is more important to be mindful of turnover ratios in the lower range than in the higher range. What strategies lend themselves best to low turnover rates? One possible approach is a passive, low turnover index fund. Another is a focus portfolio. It sounds like premarital counseling advice, says Jeffrey and Arnott, namely, to try to build a portfolio that you can live with for a long, long time. In investment management today, explains Charlie Munger, everybody wants to not only win, but to have a yearly outcome path that never diverges very much from a standard path except on the upside. Well, says Charlie, from the viewpoint of a rational consumer, the whole system is bonkers, and it draws a lot of talented people into socially useless activity. Portfolio managers counter with, we have to behave that way. It's how we are measured. Today, portfolio managers are constrained by relative performance. In the relative performance game, explains business writer Peter Bernstein, the risk in your portfolio is no longer in the securities you own. The greater risk is in the far larger number of stocks you don't own. You're short all of them. Portfolio managers run the risk of losing clients and offending consultants if their performance deviates too far away from the market return. The fear of tracking error. Performance that is too far away from the market's return has, according to Charlie Munger, hobbled the industry. We have spent a good deal of this chapter on the ups and downs of mutual funds. We did so, you will recall, because mutual funds are familiar and therefore an easy example. But do not imagine for 1 minute that the erroneous thinking is limited to managers of mutual funds. They are used here merely to exemplify the broad trends that thread their way through the entire investment world. By observing what these mutual fund managers do and how they think, we can learn much about what you should do and how you should think. What we have learned is that short-term performance does not necessarily identify superior portfolio managers any more than poor short-term performance excludes them. The time horizon we use to measure ability is simply too short to draw any meaningful conclusions. However, using alternative economic benchmarks such as look-through earnings may be a way for you to gauge your progress when price deviates from expected returns. We also learned that low turnover translates to higher returns in two simple obvious ways. Fewer transactions means lower trading costs. Finally, don't overlook the value of unrealized capital gains. With the exception of passive index funds, focus investing gives you the best opportunity to compound this unrealized gain into major profits. The Berkshire system is not bonkers, Charlie Munger concludes. I'd say that Berkshire Hathaway is adapting to the nature of the investment problem as it really is. Chapter 5. The Warren Buffett Way Tool Belt. The investor of today does not profit from yesterday's growth. Warren Buffett. With the Warren Buffett Way, I hoped to produce a useful book that would help investors understand how Warren Buffett goes about selecting common stocks. The book outlines a number of investment tools or tenets that Buffett applies when evaluating possible purchases, so that ultimately readers would be able to thoughtfully analyze and purchase a company as Buffett would. I am confident that since its original publication in 1994, the book has endured sufficient scrutiny by professional and individual investors, as well as academicians and business owners. To date, the feedback we have received has been overwhelmingly positive. The book appears to genuinely help people invest more intelligently. The underlying principles haven't changed much since the Warren Buffett way first came out. That's why they call them principles, Buffett once said. But many readers have asked for clarification about applying the tenets in today's market. Also, the continuing debate about growth versus value deserves our attention, and some newer issues have presented themselves. The economic value added, EVA, approach, and the role of technology. Can we use the Warren Buffett way template to pick technology companies? Market tenet: how to value a business. Determining the intrinsic value of a company, the first and most critical step in the Buffett decision process, is both art and science. The science involves a fairly straightforward bit of mathematics. To calculate the current value of a business, you start by estimating the cash flows that you expect will occur over the life of the business, and then discount that total backward to today using an appropriate discount rate. If we could see, in looking at any business, its future cash inflows and outflows between the business and its owner over the next 100 years, or until the business is extinct, and then could discount them back at the appropriate interest rate, that would give us a number for intrinsic value, says Buffett. This concept, postulated by John Burr Williams in The Theory of Investment Value, is as true today as it was when first written more than 60 years ago. Some people find it easier to compare this process to that used when valuing a bond. The mathematics are the same. Instead of cash flow, bonds have coupons, and instead of an indefinite period, bonds have a finite life, at which point they return the invested capital back to the owners. It would be like looking at a bond with a whole bunch of coupons on it that matured in 100 years, explains Buffett. Well, businesses have coupons that are going to develop into the future, too. The only problem is that they aren't printed on the instrument. Therefore, it's up to the investor to estimate what those coupons are going to be. Estimating the amount of the coupons, then, is a matter of two numbers: the probable future earnings and the discount rate used to bring those future earnings back to present dollars. For the second number, the discount rate, Buffett generally uses the rate then current for long-term government bonds. Because the certainty that the U.S. government will pay its coupon over the next 30 years is virtually 100%, we can say that this is a risk-free rate. As Buffett explains, we use the risk-free rate merely to equate one item to another. According to Buffett, it is simply the most appropriate yardstick with which to measure a basket of all different investment types, including government bonds, corporate bonds, common stocks, apartment buildings, oil wells, and farms. Buffett does not adjust the discount rate for uncertainty. If one investment appeared riskier than another, he would keep the discount rate constant and instead adjust the purchase price. He would, in other words, obtain his margin of safety not by including a premium for equity risk, as the capital asset pricing model requires, but by buying at a lower purchase price to begin with. If you understand a business and if you can see its future perfectly, then you obviously need very little in the way of margin of safety, says Buffett. Conversely, the more vulnerable the business, the larger margin of safety you require. In the Warren Buffett way, we aligned Buffett's tenets with several of Berkshire Hathaway's largest common stock holdings to create case studies that we could learn from. Several of these case studies involved companies whose coupons could reasonably be expected to grow in perpetuity and whose growth in earnings exceeded the risk-free rate. With them, it was necessary to use a two-stage dividend discount model, one growth rate for an initial period, then a lower rate for a second, longer period. Buffett's 1988 purchase of Coca-Cola is a good example. At the time, the long-term government bond rate was 9%, and Coca-Cola's growth rate was 15%. Subtracting 15% from 9% would give us a negative number, making the calculation nonsensical. To overcome this limitation, I used the two-stage discount model. First, I started with the assumption that Coca-Cola would grow its owner earnings, net income plus depreciation, amortization, minus capital expenditures, at an above-average rate for at least 10 years, then would slow to a more average 5% rate thereafter. In year 11, I then could subtract the 5% earnings growth from the 9% risk-free rate and get a rate of 4% for discounting the company's earnings into the future. Many of the questions I have been asked since the Warren Buffett Way was published have to do with the dividend discount model and specifically with my assumptions. Some readers have argued that Coca-Cola will surely grow its earnings at the 15% rate far past 10 years, and thus I was too conservative in my projections. Others have insisted that looking out 10 years is far too difficult, and I should have used the 15% growth rate for only 5 years. Both points are valid, and hence neither answer is perfect. But remember what Buffett says. It is better to be approximately right than precisely wrong. The issue is not so much whether Coca-Cola grows its cash at a 15% rate for 5 years, 7 years, or 10 years. The real issue is that we take the time to do the research and calculate intrinsic value, rather than relying on shortcut methods such as price-earnings ratio, price-to-book ratio, or relative measures to the market. Although precise to the decimal, these methods tell you nothing about the value of your investment. The other question I am commonly asked in regard to the dividend discount model is this. That was all well and good when the risk-free rate was 9%, but now it's more like 5% or 6%. Now what? When the interest rate is 6%, using a 5% residual growth rate discounts owner earnings at a paltry 1%. What would Buffett do? Buffett tells us that in a low interest rate environment, he adjusts the discount rate upward. When the bond yields dipped below 7%, Buffett adjusted his discount rate up to 10%. If interest rates work themselves higher over time, he has successfully matched his discount rate to the long-term rate. If they do not, he has increased his margin of safety by 3 additional points. Financial tenet. To EVA or not to EVA? That is the question. There has been little debate about the financial tenets outlined in the Warren Buffett Way. No one disagrees that an attractive company is one that enjoys high profit margins and generates cash earnings for its owners. The attraction continues if the net profits of the company earn a high return on the company's equity. However, there has been considerable debate about the economic value-added EVA approach and whether it has a place in Buffett's thinking. EVA, trademarked by the New York consulting firm Stern Stewart, is a measurement system that determines whether the return on investment exceeds the cost of capital. Over the past several years, many companies, including Coca-Cola, Eli Lilly, and AT&T, have adopted the EVA approach. To calculate, start by determining a company's cost of capital and then subtract the company's net earnings. Cost of capital is cost of debt plus cost of equity in proportionate measures. Cost of debt is simply the interest rate the company pays on borrowed money, adjusted for interest expense deductibility. The cost of equity is determined by the riskiness of the business as measured by the capital asset pricing model. The weighted average cost of capital, then, is the equity percentage of the capital structure times its cost plus the debt percentage times its cost. For example, if a company's capital structure was 60% equity and 40% debt, and if the equity cost was 15% and the interest rate on the debt was 9%, the company's weighted average cost of capital would be 12.6%. That's 60% times 15% plus 40% times 9%. If the company went on to earn 15% return on capital that cost it 12.6%, we can say the company added economic value. If it earns at this higher rate consistently, its share price usually rises. On the other hand, if the company earns 10% on its capital for several years running, its share price would typically decline. EVA is one type of measuring stick, one specific hurdle rate. Buffett has a different measuring stick. He measures a company's hurdle rate by its ability to grow its market value by a rate that is at least equal to the value of the company's retained earnings. For every dollar a company retains, Buffett argues, it should create at least $1 in market value. From high above, it may appear that Buffett's $1 retained for $1 market value and Stern Stewart's EVA are intellectually similar. But Buffett has trouble embracing the finer points of EVA. First, The EVA formula is based on the capital asset pricing model, which relies on price volatility to measure risk. We already know Buffett's opinion on the idea that a more volatile stock is riskier. Second, since cost of equity is always higher than cost of debt, in the EVA model, the cost of capital actually declines when the relative use of debt increases. EVA proponents would have a hard time convincing Buffett, with his liking for companies that are debt-free or close to it, that higher debt is a good thing because it equals lower cost of capital. The cost of capital is one of the business world's great mysteries. EVA is but one approach that seeks to set that cost. Buffett may not use EVA to calculate cost of capital, but that doesn't mean he disregards the question. All of Berkshire Hathaway's subsidiaries are charged for the capital they request from Buffett. He acknowledges that he doesn't use complex formulas. Rather, we just figure it's simpler to charge people a fair amount for the money and then let them figure out whether they really want to buy a new splitter or whatever it may be. It varies a little depending on the history of when we came in and what the interest rate was when we bought it, but generally we charge people something like 15% on capital. We find that 15% gets their attention, but shouldn't be such a high hurdle rate that things we want to do don't get done. It's important to keep in mind that Buffett's internal benchmark for Berkshire Hathaway is that the company overall needs to grow at a minimum rate of 15%. Therefore, 15% is also his hurdle rate for capital. His requirement is that whenever he provides capital to any of the subsidiaries, whatever the capital is used for, new research facility, new equipment, new advertising campaign, must ultimately produce a return of at least that same rate. Berkshire Hathaway and EVA are both setting a cost of capital. Granted, they attack the problem in different ways, but both seek the same end result: to reward companies that earn above the cost of capital and punish the group that earns below the cost of capital. As Buffett remarked at Berkshire's 1995 annual meeting, "I don't think it's a very complicated subject. I don't need EVA to know that Coca-Cola has added a lot of value." Management tenet. Can we value managers? The highest compliment Warren Buffett can pay a manager is that the manager unfailingly behaves and thinks like an owner of the company. Managers who behave like owners tend not to lose sight of the company's prime objective, increasing shareholder value, and they tend to make rational decisions that further that goal. But how can we distinguish managers who are actively working to increase shareholder value from their counterparts whose commitment to this idea is only lip service? In other words, can we place a value on management? Warren Buffett applies three tenets about a company's management: rationality, candor, and resisting the institutional imperative. These three characteristics are summarized briefly here. As we have learned, if the company generates high returns on equity, the duty of management is to reinvest, for the benefit of shareholders, those earnings back into the company. However, if the earnings cannot be reinvested at high rates, management has three options. 1. Ignore the problem and continue to reinvest at below-average rates. 2. Buy growth. Or 3. Return the money to shareholders who then might have a chance to reinvest the money elsewhere at higher rates. Only one choice is, in Buffett's mind, rational, and that is option number 3. As we attempt to measure the value of management, the decision made at this crossroads gives us a good clue. The choice that management makes will prove either valuable or disappointing for shareholders long before the results are compiled in an annual report. After rationality, we should look at management's candor. Over time, every company makes mistakes, both large and inconsequential. Too many managers have the tendency to report results with excess optimism rather than honest explanation. There is something admirable about the manager who, with courage, discusses the failures of the company with shareholders. It is Buffett's belief that a manager who confesses mistakes publicly is more likely to correct them. If allocation of capital is simple and logical, why is capital so poorly allocated? If management stands to gain wisdom and credibility by facing mistakes, why do annual reports trumpet only success? The answer, Buffett has learned, is the unseen force called the institutional imperative, the lemming-like tendency of corporate management to imitate the behavior of other managers, no matter how silly or irrational it may be. Thinking independently and charting a course based on rationality and logic are more likely to maximize the profits of the company than a strategy that can best be described as follow the leader. Evaluating management along these three dimensions is more difficult than measuring financial performance for the simple reason that human beings are more complex than numbers. Indeed, many analysts believe that because measuring human activity is vague and imprecise, we simply cannot value management with any degree of confidence, and therefore the exercise is futile. Without a decimal point, they seem to suggest, there is nothing to measure. Others hold the view that the value of management is fully reflected in the company's performance statistics, including sales, profit margins, and return on equity, and that no other measuring stick is necessary. Both of these opinions have some validity, but neither is, in my view, strong enough to outweigh the original premise. The reason for taking the time to evaluate management is that it gives you early warning signs of eventual financial performance. If you look closely at the words and actions of a management team, you will find clues that will help you in measuring the value of their work long before it shows up in the company's financial reports or in the stock pages of your daily newspaper. Doing so will take some digging on your part, and that may be enough to discourage the weak of heart or the lazy. That is their loss, and your gain. If the idea of measuring management still seems vague, Buffett offers a few tips. He suggests reviewing annual reports from a few years back, paying special attention to what management said then about strategies for the future. Then compare those plans to today's results. How fully were they realized? Also, compare strategies of a few years ago to this year's strategies and ideas. How has the thinking changed? Buffett also suggests that it can be very valuable to compare annual reports of the company you are interested in with reports from similar companies in the same industry. It is not always easy to find exact duplicates, but even relative performance comparison can yield insights. A focus investor is ideally suited to the task of measuring management. Someone who owns but a few companies and plans to own them for several years has a real opportunity to get to know management, track back through annual reports, and begin to develop a sense of the management's history. Follow your companies in the press. Read what management says and what others say about them. If you notice that the chairman recently made a speech or presentation, get a copy from the Investor Relations Department and read it carefully. Make use of the company's web pages for up-to-the-minute information. In every way you can think of, raise your antennae. The important point is, do not dismiss the premise about valuing management because the task is not simple. The more you keep your eyes open for clues, the more attuned you will be and the easier the process will become. Perhaps it will help to remember why you are doing all this. You will learn bits of information that will ultimately affect share prices, but you will have them in advance. If, as Buffett suggests, the market is frequently, though not always efficient, valuing management is the one analytical tool that can put you ahead of the market. Growth versus value, the continuing debate. Warren Buffett's approach to picking stocks has changed very little over the last 20 years. He thinks about the company, the management, the financials, and the asking price, in that order. It is by all appearances a simple, straightforward approach. Yet for all its simplicity, Buffett's approach to investing is caught in a long-standing intellectual tug-of-war that seeks to distinguish value investing from growth investing. Traditionally, value investor has been used to describe someone looking for stocks that are selling at a tangible discount to underlying value, as reflected in a low ratio of price to book value, a low price-earnings ratio, or a high dividend yield. Growth investors seek to make money by aligning themselves with companies whose earnings are growing very rapidly, and presumably will continue to do so. Most analysts, says Buffett, feel they must choose between two approaches customarily thought to be in opposition, value and growth. Indeed, many investment professionals see any mixing of the two terms as a form of intellectual cross-dressing. Buffett, you may not be surprised to learn, has a different view on value and growth. The value of a stock, Buffett has explained on several occasions, is the net cash flows of the investment that occur over the life of the investment, discounted at the appropriate interest rate. Growth, he points out, is simply a part of the calculation that pertains to the cash flow. In our opinion, says Buffett, the two approaches, value and growth, are joined at the hip. Charlie Munger, whose few words are always chosen carefully, says, "The whole concept of dividing it up into value and growth strikes me as twaddle. It's convenient for a bunch of pension fund consultants to get fees prattling about, and a way for one advisor to distinguish himself from another. But to me, all intelligent investing is value investing." Despite Buffett's and Charlie's contention that there is no meaningful difference between growth investing and value investing, the investment industry is still obsessed with separating these two functions. If you follow the Warren Buffett way, you will, from time to time, confront the inevitable question, are you a growth investor or a value investor? Considering Charlie's point of view, it is probably best to identify yourself as a value investor, but be careful not to fall into the trap of buying stocks simply because they are designated as typical value stocks. One person who has successfully navigated the divide between growth and value is William H. Miller III. Bill's track record is, without question, impressive, but it is how he achieved the investment return that holds a valuable lesson for us all. Bill Miller and the Legg Mason Value Trust. In 1982, Legg Mason, a Baltimore-based brokerage and money management firm, launched its flagship mutual fund, Value Trust. From 1982 until 1990, Value Trust was co-managed by Ernie Keene, the former head of research at Legg Mason, and a bright but untested Bill Miller. Bill's pathway to the money management business was unusual. While his competitors were tied up in business schools studying modern portfolio theory, Bill was studying philosophy at Johns Hopkins Graduate School. While other money managers in training studied Markowitz, Sharpe, and Fama, Bill read William James's Pragmatism and John Dewey's Essays in Experimental Logic. After a brief period as a corporate treasurer which helped him understand how companies work, Bill landed at Legg Mason's research department, where he then joined Ernie in managing Value Trust. During the 1980s, Value Trust was an exercise in two disciplines. Ernie followed Ben Graham's approach of buying companies that were selling at low-price earnings ratios and discounts to book value. Bill took a different course. "My approach," he explained, "is more the theoretical approach that Graham talks about and that Warren Buffett has elaborated on, which is that the value of any investment is the present value of the future cash stream. The trick is to value that and thus value the assets rationally and buy them at a big discount." During 1990, Bill assumed full control of Value Trust and at that point began to put the full weight of his investment approach into the fund. What happened next has not been repeated by any other general equity fund in this decade. For 8 consecutive years, from 1991 to 1998, Value Trust consistently outperformed the Standard & Poor's 500 index. "Bill takes big positions and takes the long view," said Barron's Eric Savitz. "Over the long term, you can see how it has worked." Savitz, who followed Bill's success while writing the mutual fund column for Barron's, remembers Bill as very low-key. He was non-promotional. There were plenty of other money managers who jumped on CNBC and talked themselves up, but Bill is not the kind of person who trumpets his own success. Still, he was more insightful about the stocks than anybody I knew. Today, Bill manages over $10 billion in assets for Legg Mason, including the $7 billion Value Trust. Although he is not a focus investor by strict definition, he comes very close. He routinely keeps Value Trust in only 30 to 40 names, with over half of the assets invested in just 10 stocks. There are several parallels between Bill Miller and Warren Buffett, explains Amy Arnott, editor of Morningstar. He does have a very low turnover strategy, and his portfolio is very concentrated compared to other equity funds. His method of valuing companies is similar to Buffett in that they both look at free cash flow as a measure of intrinsic value. Bill, even though he is a value manager, does not always show up in the value area of the style box, that shorthand summary of attributes used by several financial publications. If you look at traditional measures of value, including price to earnings and price to book, Bill simply does not always fall into this mold. We're trying to distinguish companies that are deservedly cheap from those that are undeservedly cheap, he explains. There are a lot of companies that trade at low valuations that are down in price and are not attractive. The trick is to separate the ones that are from those that aren't. Bill's discriminating taste for companies coupled with his long holding period has certainly helped Value Trust achieve its status as one of the best mutual funds of the 1990s, but it has also come with a price. Because Value Trust holds a collection of businesses that appear to be a cross-blend of growth and value companies, Bill has not been able to escape the dogged controversy over whether he is a value manager or growth manager, as evidenced by Jim Cramer's biting report on TheStreet.com. Cramer, the highly charged and intellectual founder of TheStreet.com, wrote a scathing piece entitled Wrong, Rear Echelon Revelations, Mutual Funds and Value Judgments. In the report, Cramer openly attacked several value funds that also owned stocks that matched the industry definition of growth stocks. Citing the value index chart from Investors Business Daily, Cramer pointed out that several of the value funds in this index also owned large positions in companies that included Dell Computer, America Online, Microsoft, and Lucent. What a preposterous notion of value these stocks represent. Value, give me a break, Cramer wrote. Cramer continues, I don't want to sound too cynical about this, but I think managers aren't thinking about anything. Mutual funds have about the worst truth in labeling problem I have come across in any industry. I think there should be a rule. The term value should not get applied to firms that own such high multiple stocks. Value in this world has simply become a masquerade, a mean-spirited marketing tactic that lures people in the door who would otherwise have no desire to own such nosebleed stocks. Miller responded with a letter that I believe eloquently captures the essence of the growth versus value debate. His comments are, with permission, included here. Jim, Legg Mason Value Trust, the fund I run, may be the offender that set you off in your value growth column, since we are in the IBD Value Index and have Dell and AOL as our largest two positions. We don't own Lucent or Microsoft. Of course, in 1996, when we were buying Dell at $4 and trading at 6 times with a 40% return on capital, no one thought we were being heretical. And when we were loading up on AOL at $15 in late 1996, people just thought we were nuts to buy something that was probably going out of business due to either the Internet or Microsoft or their own incompetence. The issue, of course, is how can they be value now with PEs and P-book in the stratosphere? Part of the answer has to do with general investment strategy. With money managers turning their portfolios north of 100% per year in a frenetic chase to find something that works, our glacial 11% turnover is anomalous. Finding good businesses at cheap prices, taking a big position and then holding for years used to be sensible investing. In a speculative market, long-term investing is rare, but it's what we do. We see no reason to sell a good business just because the stock price has gone up a lot or because some amount of time has passed. The better answer is that price and value are two different and independent variables. As Buffett has pointed out, there is no theoretical difference between value and growth. The value of any investment is the present value of the future cash flows of the business. Value and growth do not carve the world at the joints. The terms are mainly used by consultants to allow them to carve the world of money managers up for clients. They represent characteristics of stocks, not of businesses. As Charlie Munger once said, the distinction is twaddle. With the market beating 91% of surviving managers since the beginning of 1982, it looks pretty efficient to me. Since the computer is not a scarce resource and databases are not in short supply, accounting-based stock factors, price earnings, price book, price cash flow, etc., that the computer can identify and backtest are unlikely to lead to robust performance. Any combination of stock factors that appears to hold the key to outperformance will be quickly arbitraged away. There is no algorithmic way to outperform. Any portfolio that outperforms over any length of time does so because it contains mispriced securities. The market was wrong about the future of that aggregate. We look directly for mispricings by comparing what the market says a company is worth with what we believe it is worth using a multi-factor methodology. This methodology starts with the accounting-based stuff and moves through private market value analysis, leverage buyout analysis, looking at liquidating value, and of course involves a discounted cash flow model. Valuation is a dynamic, not a static process. When we first valued AOL, it was trading in the mid-teens. We believed the business was worth $30 or so. Now we value the business at $110 on the low end to $175 based on what we think is a conservative discounted cash flow. If we are right about the long-term economic model, the number could be much higher. No one complains when we were loaded with General Motors or Chase, good, old, easy-to-understand values, or when we're buying perpetual dogs like Toys R Us or Western Digital in the midst of massive losses. It's the Dells and AOLs people object to. And what they seem to object to most is that we didn't sell Dell at $8 like other value guys did because historically PC stocks traded between 6 and 12 times earnings. So when Dell hit 12 times, it must no longer be of value. We are delighted when people use simple-minded accounting-based metrics and then align them on a linear scale and then use that to make buy and sell decisions. It's much easier than actually doing the work to figure out what the business is worth, and it enables us to generate better results for our clients by doing more through analysis. We own GM and AOL for the same reason. The market is wrong about the price because both companies trade at discounts to the intrinsic value of the underlying business. Best regards, Bill Miller. End quote. It is a classic argument. I believe Bill's letter will be studied by investors and academicians alike. It certainly caught Jim Cramer's attention. Quote, Dear Bill, wow, that was eye-opening. You are truly doing something different. The anomalies of massive price increases, great stock picking by you, and the need to keep taxes low all lead to something special on your part, and I certainly apologize that my value net piece brought you in. Looks like I have to dig deeper than just a chart with names to understand the value conundrum. Excellent work. Terrific response, and I thank you for taking the time out to share it with us. Oh yes, and congratulations for spotting Dell and AOL so early. Jim Cramer. End quote. In 1998, I joined Bill Miller at Legg Mason, bringing with me the Focus Trust Mutual Fund and its shareholders. The press took notice of the change and immediately questioned how Focus Trust would fare with a new money management group that widely owned technology companies. Bill Miller, the world's other great investor, ranks right up there in the pantheon of all-time greats, wrote Sandra Ward at Barron's. Yet, unlike Buffett, Bill Miller's a big believer in technology. Indeed, it has been Miller's heavy bets on technology shares, in addition to heavy weightings in financials, that have helped push his performance beyond the benchmarks. What would happen, these writers were asking, when the Warren Buffett way blended with the Bill Miller way? Could we use the Warren Buffett way to pick technology companies for Focus Trust? The Warren Buffett way and technology companies. Because Berkshire Hathaway does not own any technology companies, many people have assumed that technology companies as a group cannot be analyzed with a degree of confidence, or Buffett would have done so. Not true. Buffett easily admits he doesn't feel competent to understand and value technology companies. At the 1998 Berkshire annual meeting, he was asked whether he would ever consider investing in a technology group at some point in the future. Well, the answer is no, he responded, and it's probably been pretty unfortunate. I've been an admirer of Andy Grove and Bill Gates, Buffett continued, and I wish I'd translated that admiration into action by backing it up with money. But when it comes to Microsoft and Intel, I don't know what the world will look like 10 years from now, and I don't want to play in a game where the other guy has an advantage. I could spend all my time thinking about the technology for the next year and still not be the 100th, 1,000th, or even the 10,000th smartest guy in the country in analyzing those businesses. There are people who can analyze technology, but I can't. This thinking is echoed by Charlie Munger. The reason we are not in high-tech businesses is that we have a special lack of aptitude in that area. The advantage of low-tech stuff is that we think we understand it fairly well. The other stuff we don't, and we'd rather deal with what we understand. Why should we play a competitive game in a field where we have no advantage, maybe a disadvantage, instead of playing in a field where we have a clear advantage? Playing games of only average chance can have a negative impact on one's net worth. Are you willing to bet your life savings on periodic coin-flipping games? Each of you will have to figure out where your talents lie, counsels Charlie, and you will have to use your advantages. But if you try to succeed in what you're worst at, you're going to have a very lousy career. I can almost guarantee it. For years, value investors wrongly stayed away from technology companies because of Buffett's lack of activity in this area. Wrongly perceiving they could not analyze this new industry, they now find themselves far behind the curve among a group of talented competitors. Most value investors use historical valuations to determine when stocks are cheap or expensive, explains Bill Miller. However, if an investor uses only historical models, their evaluation methodologies become context-dependent. In other words, historical valuation models work as long as the future looks very much like the past. The problem facing most value investors is that the future is different from the past in many respects, says Miller, and importantly, one of the major differences is the role of technology in society. Actually, I think that in many cases, technology lends itself especially well to the Warren Buffett way template, Miller continues, which is really just a toolkit for sharpening your analytical ability so you can select out of the whole universe of potential investments those that are likely to have the highest probability of giving you an above-average return over a long period. From that perspective, we can see that several technology companies exhibit the economic traits Buffett admires the most: high profit margins, high returns on capital, ability to reinvest the profits back into a fast-growing company, and management that acts in the interests of shareholders. What we have difficulty doing is estimating the future cash flows of the business, so we can then discount back to the present and get some sense of intrinsic value. The problem that most people have with trying to value technology companies is that the picture of the future is so uncertain, explains Lisa Rapuano, Vice President and Technology Advisor of Legg Mason Fund. So you have to think about several possible outcomes rather than just one. This can create a greater variance in the potential future payoff from a long-term investment. However, if you really dig into the key aspects of the company you're looking at, the potential size of its market, its theoretical profitability, its competitive position, you can understand exactly what is driving the differences between one scenario and another, and that will reduce your uncertainty level. We still create cash flow valuations, but we often use several target values rather than a single one. Furthermore, says Rapuano, since technology is a true driver of future economic growth, and since many winning technology companies generate outsized returns when they do work, we find that the extra level of analysis pays off. It can lead to returns far in excess of what we can find elsewhere, even taking the greater uncertainty into account. We already know how Warren Buffett, when valuing a company, handles the issue of uncertainty by requiring a larger margin of safety. That is one good strategy for tamping the risk of companies whose future is unclear, like technology companies. Another good strategy is to combine the purchase with a portfolio filled with stable and highly predictable companies. Buffett is quoted as saying that the next great fortune will be made in identifying what will be the new franchises. I believe technology companies are the modern-day equivalent of Buffett's franchise factor, argues Bill Miller. In Buffett's consumer products world, brand awareness, pricing power, share of mind are all factors included in a franchise. In the technology world, the franchise factors include network effects, positive feedbacks, lock-in, and increasing returns. I think a lot of people approach technology with a thinking model that is defective, Miller adds. They believe technology is very difficult to understand, so therefore they don't try to understand it. They have already made up their minds in advance. Admittedly, there is a learning curve to understanding technology, but I would argue that becoming accomplished in this field is not the sole domain of computer wizards. When we first began to study Buffett's cash flow franchise model, we had to switch our thinking away from Graham's low-price earnings ratio and discount-to-book thinking. There was at the time new terminology, new definitions, a new way to look at accounting statements, and the need to understand the dividend discount model. Learning about technology will require the same sort of mental shift. We will have to learn new words and new economic models. We will have to analyze accounting statements somewhat differently. But in the end, the intellectual challenge is no greater than the switch we made when analyzing how Buffett turned away from the classic value investing, defined as buying only cheap securities, to a modern method of purchasing outstanding companies at reasonable prices. It is like anything new, says Miller. You do have to spend time to understand it. Miller points out that Buffett and Peter Lynch have said that learning is simply a matter of observing what is going on around you. Yes, people are still buying Coke, Gillette razor blades, and using their American Express card, says Miller, but they are also using America Online, Microsoft software, and buying Dell computers. And that's ubiquitous. Security Analysis Revisited. Once a week, 50 fourth-term MBA students from the Columbia University Graduate School of Business scramble into Uris Hall to attend a 3-hour lecture course titled Security Analysis, the same class that Ben Graham taught 70 years ago. Today, the lectures are delivered by Professor Michael Mauboussin. When he is not teaching, Mauboussin spends his time at Credit Suisse, First Boston, enlightening his colleagues and the firm's clients. Each year when I stand in front of the class for the first time, I get a lump in my throat, confesses Mauboussin. I feel an enormous amount of humility trying to perpetuate a tradition which was started by Benjamin Graham and included students like Warren Buffett. There is a tremendous amount of responsibility here. Mauboussin's lectures encompass 3 broad concepts. First, he says, I emphasize an interdisciplinary approach to investing. Ben Graham was a worldly individual who was able to work into his teachings the ideas from many other disciplines. We attempt to do the same thing. We look not just at finance books, but at other models and metaphors, thinking how they might apply to investing. Second, we try to understand the role of psychology in investing. Ben Graham's Mr. Market is a famous concept and is still valid today. It is important to understand that investing is a social activity and that human psychology plays an important role in the process. Lastly, we talk at length about the margin of safety concept, not only how Ben Graham thought about it, but how it can be evidenced in probability statements. Looking back over the last 70 years, it is amazing to see how the world of investing has changed. The fundamental concepts haven't changed. It is still crucial to buy good financial businesses run by able managers available at sensible prices. But the economy and the world of business have evolved into quite different forms, and this has required investors to evolve their mental models to keep pace with the changing world. I asked Professor Mauboussin what advice would he give a young person setting forth into the world of investing. I would first tell the person they need to understand the economic models, including not only the accounting numbers and financial statements, but how businesses work and interact as competitors. Second, they would need to understand the role and limitations of human beings in the investment process. And third, I would tell them to work hard, but not too hard. Working hard, explains Mauboussin, means always having your mind working and reading as much as you can, and not only in the financial area but in other areas, so to build and fortify the mental models necessary to become successful. When I say don't work too hard, what I mean is there is a tendency to equate activity with getting things done, and in money management it just doesn't work that way. It is very often the people who make fewer but bigger decisions that tend to do better than those who are making a lot of decisions in the name of being busy. If Ben Graham were alive today, I think he would approve. He surely would feel a great deal of satisfaction about the legacy of security analysis. Over the years, a distinguished line of professors have taught the course, and many gifted students have profitably applied its lessons to the world they live in. Chapter 6. The Mathematics of Investing. We try to think like Fermat and Pascal would if they'd never heard of modern finance theory. Charlie Munger. As a boy, Warren Buffett was always fascinated with numbers. We already know he invested in common stocks at a young age, but not many people realize that his relationship with numbers goes much further and much deeper than balance sheets and income statements. When he wasn't thinking about the stock market, young Buffett was tackling other mathematical puzzles. Once he decided to calculate whether composers of church hymns lived a longer life than other people. The probabilities of longevity, he learned, are not assigned to the musically gifted. Today, numbers surround Buffett, and not just stock market numbers. Berkshire's insurance business, which may be the greatest math challenge of all, is also a lesson in statistics and probabilities. When he is not thinking about the insurance business or the stock market, Buffett is often thinking about the numbers in his favorite pastime, bridge. A passionate player since his college days, Buffett spends hours each week playing bridge, and when he cannot play in person, he logs onto the internet and plays with other bridge fanatics scattered across the country. Buffett sees strong parallels between the game of bridge and investing in the stock market. It's a game of a million inferences, he explains. There are a lot of things to draw inferences from. Cards played and cards not played. These inferences tell you something about the probabilities. It's got to be the best intellectual exercise out there. You're seeing through new situations every 10 minutes. Bridge is about weighing gain-loss ratios, says Buffett. You're doing calculations all the time. Anyone who has interacted with Buffett will tell you he has a special gift for quick calculations. Chris Stavro, a New York money manager and longtime Berkshire Hathaway shareholder, remembers his first meeting with Buffett. I asked him whether he ever used a calculator. Buffett replied, "I never owned one and I wouldn't know how to use one." "But how do you do more complicated calculations?" Stavro pressed. "Are you gifted?" "Oh, no," Buffett said. "It's just that I've been working with numbers for a long time. It's number sense." "Can you give me an example, like, what's 99 times 99? Without missing a beat, Buffett replied, 9,801. Stavro asked Buffett how he knew that. He answered that he had read it in Feynman's autobiography. Richard Feynman, a Nobel laureate in physics who was a member of the U.S. atomic bomb project, was once asked the same question. In his autobiography, Surely You're Joking, Mr. Feynman, he recounts the question and provides the answer. So, of Warren Buffett, we can deduce that either 1. He remembers everything he reads, or 2. He can do calculations in his head with lightning speed. Stavro pressed for one more example. If the price of a painting goes from $250 to $50 million in 100 years, what's the annual rate of return? Once again, Buffett's answer was instantaneous. 13.0%. The astonished Stavro asked, "How did you do that?" Buffett pointed out that any compound interest table would reveal the answer. So should we deduce that he's a walking interest table? Maybe. Another way to approach the problem, said Buffett, was to go by the number of times it doubles. $250 doubles about 17.6 times to get to 50 million. A double every 5.7 years, or about 13% a year. Simple, he seemed to say. Despite Buffett's humility, it is clear he is mathematically gifted. For this reason, many skeptics have claimed that Buffett's investment approach works because of this facility, and therefore excludes those who don't have it. Not true, say Buffett and Charlie Munger. To apply Buffett's investment approach does not require investors to learn advanced mathematics. On the contrary, it's very simple algebra, explains Munger. It's not hard to learn. What is hard is to get so you use it routinely almost every day of your life. The Fermat-Pascal system is dramatically consonant with the way the world works, and its fundamental truth. So you simply have to have the technique. Probability theory. It is a vast oversimplification, but not an overstatement, to say that the stock market is an uncertain universe. In this universe are hundreds, thousands of single forces that combine to set prices, all of which are constantly in motion, any one of which can have a drastic impact, and none of which is predictable to an absolute certainty. The task for investors, then, is to narrow the field, to identify and remove that which is the most unknown, and to focus on the least unknown. And that is an exercise in probability. When we are unsure about a situation but still want to express our opinion, we often preface our remarks with something like this: "The chances are," or "probably," or "it's not very likely." When we go one step further and attempt to quantify those general expressions, we then are dealing with probabilities. Probabilities are the mathematical language of uncertainty. What is the probability of a cat giving birth to a bird? 0. What is the probability that the sun will rise tomorrow? That event which is considered certain is given a probability of 1. All events that are neither certain nor impossible have a probability that is a fraction somewhere between 0 and 1.0. Determining the fraction is what probability theory is all about. In 1654, Blaise Pascal and Pierre de Fermat exchanged a series of letters that formed the basis of what today is probability theory. Pascal, a child prodigy gifted both in mathematics and philosophy, had been challenged by Chevalier de Mere, a philosopher and gambler, to solve the riddle that had stumped many a mathematician. Chevalier wanted to know how two card players could divide the stakes of a game if they had to leave before the game was completed. Pascal approached Fermat, a mathematical genius in his own right, about Chevalier's challenge. The 1654 correspondence between Pascal and Fermat on this subject, says Peter Bernstein in Against the Gods, his wonderfully written treatise on risk, signaled an epochal event in the history of mathematics and the theory of probability. Although they attacked the problem differently, Fermat used algebra, whereas Pascal turned to geometry, they were able to construct a system to determine the probability of several possible outcomes. Indeed, Pascal's triangle of numbers solves many problems, including the probability of your favorite baseball team winning the World Series after losing the first game. The work by Pascal and Fermat marks the beginning of the theory of decision-making. Decision theory is the process of deciding what to do when you are uncertain what will happen. Making that decision, writes Bernstein, is the essential first step in any effort to manage risk. Although Pascal and Fermat are both credited with developing probability theory, it was another mathematician, Thomas Bayes, who wrote the piece that laid the groundwork for putting it to practical action. Born in 1701, exactly 100 years after Fermat, and 78 years after Pascal, Bayes lived an unremarkable life. He was a member of the Royal Society, but published nothing in mathematics during his lifetime. After his death, his paper entitled Essays Towards Solving a Problem in the Doctrine of Chances appeared. At the time, no one thought much of it. However, according to Peter Bernstein, Bayes' essay was a strikingly original piece of work that immortalized Bayes among statisticians, economists, and other social scientists. It provides a way for investors to make use of the mathematical theory of probability. Bayesian analysis gives us a logical way to consider a set of outcomes of which all are possible, but only one will actually occur. It is conceptually a simple procedure. We begin by assigning a probability to each of the outcomes on the basis of whatever evidence is then available. If additional evidence becomes available, the initial probability is revised to reflect the new information. Bayes' theorem thus gives us a mathematical procedure for updating our original beliefs, resulting from what he called a prior distribution of information to produce a posterior distribution of information. In other words, prior probabilities combined with new information yield posterior probabilities, and thus change our relevant odds. How does it work? Let's imagine that you and a friend have spent the afternoon playing Trivial Pursuit, and now, at the end of the game, are chatting about this and that. Something your friend says leads you to make a friendly wager that with one roll of the die from the board game, you will get a 6. Straight odds are 1 in 6, a 16% probability. But then, suppose your friend rolls the die, quickly covers it with her hand, and takes a peek. I can tell you this much, she says. It's an even number. Now you have new information, and your odds change dramatically to 1 in 3, a 33% probability. While you consider whether to change your bet, your friend teasingly adds, and it's not a 4. With this additional bit of information, your odds have changed again to 1 in 2, 50% probability. With this very simple example, you have performed a Bayesian analysis. Each new piece of information affected the original probability, and that is a Bayesian inference. Bayesian analysis is an attempt to incorporate all available information into a process for making inferences or decisions about the underlying state of nature. Colleges and universities use Bayes' theorem to help their students study decision-making. In the classroom, the Bayesian approach is more popularly called the decision tree theory, in which each branch of the tree represents new information that in turn changes the odds in making decisions. At Harvard Business School, explains Charlie Munger, the great quantitative thing that bonds the first-year class together is what they call decision tree theory. All they do is take high school algebra and apply it to real-life problems. The students love it. They're amazed to find that high school algebra works in life. The subjective interpretation of probability. As Charlie points out, basic algebra is extremely useful in calculating probabilities. But to put probability theory to practical use in investing, we need to look a bit deeper at how the numbers are calculated. In particular, we need to pay attention to the notion of frequency. What does it mean to say that the probability of guessing heads on a single coin toss is 1/2, or that the probability of an odd number appearing on a single throw of a die is 1/2? If a box is filled with 70 red marbles and 30 blue marbles, what does it mean that the probability is 3/10 that a blue marble will be picked? In all these examples, the probability of the event is what is referred to as a frequency interpretation, and it is based on the law of averages. If an uncertain event is repeated countless times, the frequency of the event's occurrence is reflected in the probability of the event. For example, if we toss a coin 100,000 times, the number of events that are expected to be heads is 50,000. Note that I did not say it would be equal to 50,000. The law of large numbers says the relative frequency and the probability need to be equal only for an infinite number of repetitions. Theoretically, we know that in a fair toss of a coin the chance of getting a head is 1/2, but we will never be able to say the chance is equal until an infinite number of tosses has passed. In any problem that deals with uncertainty, we will, quite obviously, never be able to make a definitive statement. However, if the problem is well defined, we should be able to list all the possible outcomes. If an uncertain event is repeated often enough, the frequency of the outcomes should reflect the probability of the different possible outcomes. The difficulty arises when we are concerned with an event that happens only once. How do we estimate the probability of passing tomorrow's science test, or the probability of the Green Bay Packers winning the Super Bowl? The problem we face is that each of these events is unique. We can look back at all the stats on the Green Bay games, but we don't have enough exact matchups with the exact personnel who played each other repeatedly under identical circumstances. We can recall previous science exams to get an idea of how well we test, but all tests are not identical, and our knowledge is not constant. Without repeated tests that would produce a frequency distribution, how can we calculate probability? We cannot. Instead, we must rely on a subjective interpretation of probabilities. We do it all the time. We might say that the odds of the Packers winning the big prize are 2-1, or the possibility of passing that hard test is 1 in 10. These are probabilistic statements describing our degree of belief about the event. When it isn't possible to do enough repetitions of a certain event to get an interpretation of probability based on frequency, we have to rely on our own good sense. Of course, you can immediately see that many subjective interpretations of those two events would lead you in the wrong direction. In subjective probability, the burden is on you to analyze your assumptions. Stop and think it through. Are you assuming a 1 in 10 chance of doing well on the science test because the material is more difficult and you haven't adequately prepared, or because of false modesty? Is your lifelong loyalty to the Packers blinding you to the superior strength of the other team? According to the textbooks on Bayesian analysis, if you believe that your assumptions are reasonable, it is perfectly acceptable to make your subjective probability of a certain event equal to a frequency probability. What you have to do is sift out the unreasonable and illogical in favor of the reasonable. It is helpful if you think about subjective probabilities as nothing more than an extension of the frequency probability method. In fact, in many cases, subjective probabilities are value added because this approach allows you to take into account operational issues rather than depend on long-run statistical regularity. Whether or not they recognize it, virtually all decisions that investors make are exercises in probability. For them to succeed, it is critical that their probability statement combines both the historical record with the most recent data available. And that is Bayesian analysis in action. Probabilities, Buffett style. Take the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain. That is what we're trying to do, says Buffett. It's imperfect, but that's what it is all about. A useful example to clarify the link between investing and probability theory is the practice of risk arbitrage. Risk arbitrage is something I've been doing for 40 years now, explains Buffett, and my boss, Ben Graham, did it for 30 years before that. A pure arbitrage is nothing more than profiting from the discrepancy in the price of a security quoted in two different markets. For example, commodities and currencies are quoted in several different markets around the world. If two separate markets quoted a different price on the same commodity, you could buy in one market and sell in the other market and pocket the difference. Risk arbitrage, which is the form more commonly practiced today, involves announced corporate mergers or acquisitions. Some speculators practice risk arbitrage on unannounced corporate events, but this is an area that Buffett avoids, and so shall we. My job, says Buffett, is to assess the probability of the events, announced mergers, actually transpiring and the gain-loss ratio. Let's preface Buffett's next remarks with this scenario. Suppose the Abbott Company began the trading day at $18 per share. Then, in mid-morning, it is announced that sometime this year, perhaps in 6 months, Abbott will be sold to the Costello Company for $30 per share. Immediately, the share price of Abbott races to $27, where it settles in and begins to trade back and forth. Buffett sees the announced merger and must make a decision. First of all, he tries to assess the degree of certainty. Some corporate deals don't materialize. The board of directors could unexpectedly resist the idea of a merger, or the Federal Trade Commission might voice an objection. No one ever knows with certainty whether a risk arbitrage deal will close, and that is where the risk comes in. Buffett's decision process is an exercise in subjective probability. He explains, if I think an event has a 90% chance of occurring and there is 3 points on the upside and there is a 10% chance that it will fall through and there's 9 points on the downside, then that's 90 cents off of $2.70, leaving a $1.80 mathematical expectation. Next, says Buffett, you have to figure in the time span involved and then relate the return of the investment to other investments available to you. If you bought one share of Abbott Company at $27, according to Buffett's mathematics, there is a potential 6.6% return. If the deal was expected to close in 6 months, the annualized return on the investment would be 13.2%. Buffett would then compare the return from this risk arbitrage with other returns available to him. Risk arbitrage carries the potential for loss. We're perfectly willing to lose money on a given transaction, arbitrage being one example, but we're not willing to enter into any transaction in which we think the probability of a number of mutually independent events of a similar type has an expectancy of loss. We hope, confesses Buffett, that we're entering into transactions where our calculations of those probabilities have validity. We can see quite clearly that Buffett's risk arbitrage estimates are subjective probabilities. There is no frequency distribution in risk arbitrage. Every deal is different. Every circumstance requires different estimations. Even so, there is value to approaching the risk arbitrage deal with some rational mathematical calculation. The process is no different when you invest in common stocks. To illustrate this, let's look at two classic Berkshire Hathaway common stock purchases, Wells Fargo and Coca-Cola. Investing in Wells Fargo and Coca-Cola. In October 1990, Berkshire Hathaway purchased 5 million shares of Wells Fargo and Company, investing $289 million in this company at an average price of $57.88 per share. With this purchase, Berkshire became the largest shareholder of the bank, owning 10% of the shares outstanding. It was a very controversial move. Early in the year, the share price traded as high as $86, then dropped sharply as investors abandoned California banks in droves. At the time, the West Coast was in the throes of a severe recession, and some speculated that banks with their loan portfolios stocked full of commercial and residential mortgages were in trouble. Wells Fargo, with the most commercial real estate of any California bank, was thought to be particularly vulnerable. Buffett was well aware of what was being said, but he came to a different conclusion about Wells Fargo. Did he know something these other investment professionals did not? Not really. He just analyzed the situation differently. Let's walk through the thinking process with him, for it gives us a clear example of how Buffett uses probabilities. First, Buffett understood the banking business very well. Berkshire had owned the Illinois National Bank and Trust Company between 1969 and 1979. During that period, Gene Abegg, chairman of Illinois National, taught Buffett that a well-managed bank could not only grow its earnings, but also earn a handsome return on equity. Importantly, Buffett also learned that the long-term value of a bank is determined by the actions of its management. Bad managers have a way of running up the costs of operations while making foolish loans. Good managers are always looking for ways to cut costs and very rarely make risky loans. Carl Reichardt, then chairman of Wells Fargo, had run the bank since 1983 with impressive results. Under his leadership, growth in earnings and return on equity were both above average, and operating efficiencies were among the highest in the country. Reichardt had also built a solid loan portfolio. Ownership of a bank is far from riskless, said Buffett. However, in his mind, the risk of owning Wells Fargo centered around three possibilities. California banks face the specific risk of a major earthquake, which might wreak havoc on borrowers that in turn destroy the bank's lending to them. The second risk is systemic, the possibility of a business contraction or financial panic so severe it would endanger almost every highly leveraged institution, no matter how intelligently run. The market's major fear of the moment is that West Coast real estate values will tumble because of overbuilding and deliver huge losses to banks that have financed the expansion. Now, Buffett said, none of these scenarios can be ruled out. However, he concluded, based on best evidence, that the probability of an earthquake or a severe financial panic was low. Buffett gives us no figures, but a low probability might be something less than 10%. Then he turned his attention to the probability of the third scenario. First, Buffett reasoned that a meaningful drop in real estate values should not cause major problems for a well-managed bank like Wells Fargo. Consider some mathematics, explains Buffett. Wells Fargo currently earns well over $1 billion pre-tax annually after expensing more than $300 million for loan losses. If 10% of all $48 billion of the bank's loans, not just its real estate loans, were hit by problems in 1991, and these produced losses, including foregone interest, averaging 30% of the principal, the company would roughly break even. Now consider that a 10% loss in the bank's portfolio would certainly qualify as severe business contraction, which Buffett had already rated a low possibility. But even if that were to occur, the bank would still break even. Buffett continued, a year like that, which we consider only a low-level possibility, not a likelihood, would not distress us. In the multiple scenarios that Buffett mentally laid out, the probability of any major long-lasting damage to Wells Fargo was at best low. Still, the market priced Wells Fargo's shares down by 50%. In Buffett's mind, the odds of making money by purchasing shares of Wells Fargo were now in the order of 2 to 1, with no corresponding increase in the probabilities of being wrong. Although Buffett doesn't assign specific numbers to his probability statements, that doesn't lessen the value of his thought process. Thinking in probabilities, subjective or not, enables you to think clearly and rationally about a purchase. The way Buffett rationalized Wells Fargo allowed him to act and profit when others were thinking less clearly. Remember, says Buffett, If you believe that your gain, weighted for probabilities, considerably exceeds your loss, comparably weighted, you may consciously purchase a risky investment. Coca-Cola is a different story. If Wells Fargo allows us to watch Buffett spread out multiple scenarios and assign various probabilities to them, Coca-Cola lets us see what he does when he thinks the probabilities are practically dead certain. In the case of Coca-Cola, we see Buffett acting on one of his guiding principles. When the probabilities of success are very high, make a big bet. Buffett does not walk us through a Bayesian analysis of his purchase of Coca-Cola. However, he has often said that Coca-Cola represented a near certain probability of success. With over 100 years of investment performance data available, Coca-Cola had something very close to a frequency distribution to analyze. Then, using the Bayesian process, which adds posterior information, Buffett could see the difference that Roberto Goizueta's management was making. Because Goizueta was selling off the poor-performing businesses and reinvesting the proceeds back into the higher-performing syrup business, Buffett knew the financial returns of Coca-Cola were going to improve. In addition, Goizueta was buying back shares of Coca-Cola in the market, thereby increasing the economic value of the business even more. Starting in 1988, Buffett could see that the market was pricing Coca-Cola somewhere between 50 and 70% below its intrinsic value. At the same time, his conviction about the company had not changed. The probabilities of Coca-Cola's share price beating the market rate of return were going up, up, and up. So what did Buffett do? Between 1988 and 1989, Berkshire Hathaway purchased $1 billion of Coca-Cola stock, an amount that came to represent over 30% of the total value of Berkshire's portfolio. The Kelly Optimization Model. Each time you step foot inside a casino, the probability of coming out a winner is pretty low. You shouldn't be surprised. After all, we all know the house has the best odds. But one game, if played correctly, gives you a legitimate chance to beat the house: blackjack. In a worldwide bestseller called Beat the Dealer, a winning strategy for the game of 21, Edward O. Thorpe, a mathematician by training, outlined a process for outsmarting the casino. Thorpe's strategy was based on a simple concept. When the deck is rich with tens, face cards, and aces, the player, let's say it's you, has a statistical advantage over the dealer. If you assign a -1 for the high cards and a +1 for the low cards, it's quite easy to keep track of the cards dealt. Just keep a running tally in your head, adding or subtracting as each card shows. When the count turns positive, you know there are more high cards yet to be played. Smart players would save their biggest bets for when the card count reached a high relative number. Buried deep inside Thorpe's book was a notation on the Kelly betting model. Kelly, in turn, took his inspiration from Claude Shannon, the inventor of information theory. A mathematician with Bell Laboratories in the 1940s, Shannon spent a good part of his career trying to find the most optimal way to transmit information over copper lines without having the information become garbled by random molecular noise. In 1948, he wrote up what he had discovered in an article called A Mathematical Theory of Communication. Inside the paper was the mathematical formula for the optimal amount of information that, considering the possibilities of success, can be pushed through the copper wire. A few years later, J. L. Kelly, another mathematician, read Shannon's article and realized that the formula could just as easily work in gambling, another human endeavor that would be enhanced by knowing the possibilities of success. In 1956, Kelly wrote a paper entitled A New Interpretation of Information Rate, in which he pointed out that Shannon's various transmission rates and the possible outcomes of a chance event are essentially the same thing, probabilities, and the same formula could optimize both. The Kelly model, often called the optimal growth strategy, is based on the concept that if you know the probability of success, you bet the fraction of your bankroll that maximizes the growth rate. It is expressed as a formula: 2p minus 1 equals x, where 2 times the probability of winning minus 1 equals the percentage of one's bankroll that should be bet. For example, if the probability of beating the house is 55%, you should bet 10% of your bankroll to achieve maximum growth of your winnings. If the probability is 70%, bet 40%. And if you knew the odds of winning were 100%, the model would say, bet your entire bankroll. The Kelly formula is optimal under two criteria. 1. Minimal expected time to achieve a level of winnings, and 2. The maximal rate of wealth increase. For example, let's say two blackjack players each have a $1,000 stake and 24 hours to play it. The first player is limited to betting only $1 on each hand dealt. Player number 2 can alter the bet depending on the attractiveness of the cards. If the second player follows the Kelly approach and bets the percent of his bankroll that reflects the probability of winning, at the end of 24 hours, it is likely he will have done much better than player number 1. Of course, the stock market is far more complex than the game of blackjack. In the game, there is a finite number of cards and therefore a limited number of possible outcomes. The market, with hundreds of common stocks and millions of investors, has an almost unlimited number of outcomes. Using the Kelly approach requires constant recalculations and adjustments throughout the investment process. Nonetheless, the underlying concept, mathematically linking degree of probability to investment size, carries important lessons for the focus investor. Let's revisit our two gamblers and their 24-hour clock. But let us imagine that instead of playing blackjack, they are investing in the stock market. Investor number 1 is limited to investing only 1% of the portfolio on each event. The other investor is allowed to alter the investment depending on how he perceives the probability of success. Which investor stands the better chance of optimally growing capital over the marking period? The investor who bets 1% on each event, knowing not every stock is an equally weighted opportunity, or the focus investor, who waits until the high probability event appears and then bets big? We have no evidence that Buffett uses the Kelly model when allocating Berkshire's capital, but the Kelly concept is a rational process, and to my mind, it neatly echoes Buffett's thinking. Buffett has counseled investors to wait until the best opportunities appear and then be willing to bet big. In any event, I have found the Kelly model useful as a mathematical explanation to help better understand the portfolio allocation process. I believe the Kelly model is an attractive tool for focus investors. However, it will only benefit those who use it responsibly. There are risks to employing the Kelly approach, and you would be wise to understand its 3 limitations. First, anyone who intends to invest using the Kelly model or not should have a long-term horizon. Even if a blackjack player has a sound model that can beat the house, it does not always hold that success will be revealed in the first few hands dealt. The same is true for investing. How many times have investors seen that they have selected the right company, but the market has taken its own sweet time in rewarding the selection? Second, be wary of using leverage. The danger of borrowing to invest in the stock market with a margin account has been trumpeted loudly by both Ben Graham and Warren Buffett. The unexpected call on your capital can occur at the most unfortunate time in the game. If you use the Kelly model in a margin account, a stock market decline can force you to remove your high-probability bets. Third, the biggest danger in playing high-probability games is the risk of overbetting. If you judge an event has a 70% probability of success, when in fact it is only 55%, you run the risk of gambler's ruin. The way to minimize that risk is underbetting, by using a half-Kelly or fractional Kelly model. This increases the safety of your bet and provides a very real psychological level of comfort. For example, if the Kelly model would tell you to bet 10% of your capital, indicating the event has a 55% probability of success, you might choose to invest only 5% instead. That's a half-Kelly. The fractional Kelly provides a margin of safety in portfolio management. That, together with the margin of safety we apply to selecting individual stocks, provides a double layer of protection. Because the risk of overbetting far outweighs the penalties of underbetting, investors should use fractional Kelly bets. This is particularly true for investors who are just beginning to use a focus investment strategy. Unfortunately, minimizing your bets also minimizes your potential gain. However, because the relationship in the Kelly model is parabolic, the penalty for underbetting is not severe. A half Kelly, which reduces the amount you bet by 50%, reduces the potential growth rate by only 25%. This seems a good place to summarize. To receive the benefit of the Kelly model, you must first be willing to think about buying stocks in terms of probabilities. Second, you must be willing to play the game long enough to achieve its rewards. Third, you must avoid using leverage with its unfortunate consequence. Fourth, you should demand a margin of safety with each bet you make. The Kelly system is for people who simply want to compound their capital and see it grow to very large numbers over time, says Ed Thorpe. If you have a lot of time and a lot of patience, then it's the right function for you. Insurance is like investing. Insurance is a lot like investing, explains Buffett. If you feel like you have to invest every day, you're going to make a lot of mistakes. To succeed in investing or writing insurance, you have to wait for the fat pitch. Warren Buffett has been in the insurance game since 1967. That was the year Berkshire Hathaway purchased National Indemnity Company. Since then, Buffett has acquired several more insurance businesses, including Geico and most recently General Ray Corporation. Geico is a direct writer of automobile insurance. Because the company sells insurance directly to the customer, bypassing the need for agents, Geico has become the low-cost provider of insurance and now stands ready to take a large segment of the $100 billion automobile insurance market. General Ray, a $16 billion merger that was completed at the end of 1998, makes Berkshire Hathaway the largest worldwide provider of supercatastrophe reinsurance. Supercatastrophe insurance policies are purchased by primary insurance companies that wish to protect themselves from the financial damage caused by natural disasters, principally hurricanes or earthquakes. Typically, a primary insurer may choose to retain the loss from a single catastrophic event up to a certain level and then reinsure through another carrier for any damages above that threshold. Berkshire Hathaway provides insurance for these supercatastrophes, insuring not only primary carriers but other reinsurance companies that wish to lay off the most severe possibility. Pricing supercatastrophe insurance is a tricky business. Because frequency distributions and precise data are unavailable, earthquakes and hurricanes do not occur often enough to build reliable statistics compared to automobile insurance, which can rely on the law of large numbers, catastrophe insurers can't simply extrapolate past experience, says Buffett. If there is truly global warming, for example, the odds would shift, since tiny changes in atmospheric conditions can produce momentous changes in weather patterns. Furthermore, says Buffett, in recent years there has been a mushrooming of population and insured values in U.S. coastal areas that are particularly vulnerable to hurricanes, the number one creator of supercatastrophes. A hurricane that caused X dollars of damage 20 years ago could easily cost 10X now. Because of the difficulty predicting when an earthquake or a hurricane is going to hit, you might assume that estimating the probabilities of these events is a total crapshoot. Not so, says Buffett. Even if perfection in assessing risks is unattainable, insurers can underwrite sensibly. After all, you need not know a man's precise age to know if he is old enough to vote, nor know his exact weight to recognize his need to diet, explains Buffett. It is not perfect science. Uncertainty of this type might cause other people to have some concerns, but not Buffett. What I can say with certainty, says Buffett, is that we have the best person in the world to run our supercat business, Ajit Jain, whose value to Berkshire Hathaway is simply enormous. Ajit is the guiding genius and developer of Berkshire's supercat business. Born in India and educated at Harvard Business School, Ajit worked for both IBM and McKinsey Consulting before joining Berkshire Hathaway's National Indemnity. It was Ajit who had the foresight to see the growing need for large supercatastrophe insurance policies and recognized that Berkshire's financial strength gave it a competitive advantage. Like Buffett, Ajit is keenly aware of the need for skill in making subjective interpretations of probability. The reality in the supercatastrophe business is that there isn't a lot of meaningful data to analyze. What you do is start with historical data, and then you make certain projections from that. It's a very subjective art form. The supercatastrophe insurance business is a perfect example of an environment of low-frequency, high-severity events. So is focus investing. The focus investor, remember, makes very few bets, but always on high-probability situations. Managed properly, then, the focus portfolio will have a low frequency of failure, but when failure does occur, it will be severe. The portfolio will take a larger than normal hit. I had the opportunity to ask Charlie Munger about the similarities between focus investing and supercatastrophe insurance. He smiled and told me the thinking is identical. If so, the history of supercatastrophe insurance will give us a sense of what focus investors can expect. By its nature, says Buffett, the supercat business is the most volatile of all insurance lines. Since truly major catastrophes are rare occurrences, our supercat business can be expected to show large profits in most years and to record a huge loss occasionally. What you must understand, however, is that a truly terrible year in the supercat business is not a possibility. It's a certainty. The only question is when it will come. Large profits in most years, occasional huge losses, and a truly terrible year at some point. That statement could as easily be a description of focus investing style as supercatastrophe insurance. Think back to the performance history of our focus investors in Chapter 4, Keynes, Munger, Ruane, and Simpson. With the potential for such losses, why does Buffett promote the supercat insurance business? The same reason he embraced the focus approach. We will get a hit from time to time with large losses, explains Buffett. Charlie and I, however, are quite willing to accept relatively volatile results in exchange for better long-term earnings than we would otherwise have had. Since most managers opt for smoothness, we are left with a competitive advantage that we try to maximize. In other words, we prefer the lumpy 15% to a smooth 12%. It's all about odds. The model I like, to sort of simplify the notion of what goes on in a market for common stocks, is the parimutuel system at the racetrack, says Charlie. If you stop to think about it, a parimutuel system is a market. Everybody goes there and bets, and the odds are changed based on what's bet. That's what happens in the stock market. Continuing this line of reason, Charlie explains as only he can. Any damn fool can see that a horse carrying a light weight with a wonderful win rate and a good position, etc., is way more likely to win than a horse with a terrible record, an extra weight, and so on and so on. But if you look at the odds, the bad horse pays 100 to 1, whereas the good horse pays 3 to 2. Then it's not clear which is statistically the best bet. The prices have changed in such a way that it's very hard to beat the system. Charlie's racetrack analogy is perfect for investors. Too often investors are attracted to a long shot that pays incredible odds, but for any one of countless reasons never finishes the race. Or sometimes they pick the sure thing without ever considering the payoff. It appears to me that the most sensible way to approach horse racing or the stock market is to lie back and wait until the good horse comes to the post with the inviting odds. Andrew Bayer, columnist for the Washington Post and author of several books on thoroughbred racing, has spent many years watching racegoers bet and has seen far too many lose money through impetuosity. At the track as elsewhere, the casino mentality, the itch to get into the action, to put down the money, toss the dice, pull the lever, to do something, compels people to bet foolishly, without taking the time to think through what they are doing. Bayer understands this psychological urge to get in the game and advises players to accommodate it by dividing their strategy between action bets and prime bets. Prime bets are reserved for serious plays when two conditions occur. 1. Confidence in the horse's ability to win is high, and 2. Payoff odds are greater than they should be. Prime bets call for serious money. Action bets, as the name implies, are reserved for the long shots and hunches that satisfy the psychological need to play. They are smaller bets and are never allowed to become a large part of the player's betting pool. When a horse player starts blurring the distinction between prime bets and action bets, says Bayer, he is taking a step that will inevitably lead toward helter-skelter betting with no proper balance between his strong and weak selections. A new way of thinking. If the whole idea of applying mathematics and probability calculations to investment decisions seems intimidating, you are not alone. As Charlie Munger once remarked, most people are total klutzes at dealing with ordinary probabilities and numbers. Is it worth the effort? Without doubt. Perhaps it will be helpful if we step back for a moment and look at the big picture, reviewing what we have learned in this chapter. One of the first things we notice when we examine Warren Buffett's approach to managing a portfolio is that he believes in making big bets on high-probability events. That leads us to the first question. What is probability, and how do we determine it? Calculating probability. If the circumstance you're investigating has only a limited number of possible outcomes, calculating probability is a matter of simple arithmetic. A die has only 6 sides, so the probability of any one of them landing face up is 1 in 6. If the number of possible outcomes is unlimited, and if looking backward you can find a large number of instances, then you can conclude probability on the basis of a frequency distribution. This is how we predict long-range weather patterns, and it is how carriers of automobile insurance establish rates for different classes of drivers. If the number of outcomes is unlimited but you do not have access to enough repetitions to make a frequency distribution, then you must do a subjective interpretation, collecting as much information as you can and analyzing it thoughtfully. In this case, your probability determination coincides with your level of confidence in your analysis. Using any of these variations, you end up with a determination of the chances that this particular event will happen expressed as a percentage, 50%, 70%, whatever. This is your estimate of probability, based on your best information at the time. But what happens if new information becomes available? Adjusting calculation to integrate new information. Suppose new information comes in, and suppose it clearly suggests that the situation might have more than one outcome, depending on various circumstances. You are then faced with a decision tree. If X happens, the probability of success is 55%, but if Y happens, the probability would change to 70%. This is Bayesian analysis. Your answer is more complex because it has several variations, but the process is the same. Take each variation, gather all the data you can, and think it through as thoroughly as you can. Then you have a probability calculation for each of the possible outcomes. Yes, it helps if you are quick with numbers, but it is not necessary. Now that we know the probability as much as it is knowable, we are ready for the second question. How much should you bet? How big is big? Determining the size of the bet. The Kelly optimization formula will tell you how much to bet, expressed as a fraction of the total. When the situation is fluid and complex, such as the stock market, you may not be able to apply the formula rigidly, but will have to make allowance for the continually shifting forces. The basic notion still applies. As the probability rises, so should the amount of the investment. Now we have two big pieces of the picture, probability and investment size. One question remains. When should you make your move? Not until the odds are in your favor. Watching the odds. The horse that is favored to win the race has the highest probability, but might not be a good bet if the odds are only 3-2. But if your information leads you to believe that another horse also has a high probability of winning and the odds are more favorable, that's when you make your big bet. Probability theory and the market. Now, let us move away from the racetrack and away from theory and put this all together into the reality of the stock market. The chain of thinking is the same. 1. Calculate probabilities. As a focus investor, you restrict yourself to a limited number of stocks because you know that in the long run it is your best chance of doing better than the overall market. So when thinking about buying a new stock, your goal is to make sure your choice will outperform the market. That is the probability you are concerned with. What are the chances that this stock, over time, will achieve an economic return greater than the market? Using frequency if it is available and subjective interpretation if it is not, make your best estimate. What you will be looking at is how closely the company you are considering matches up to the tenets of the Warren Buffett way. Do the most thorough job you can of collecting information about the company and measure it against those tenets, and convert your analysis to a number. That number represents how obvious it is to you that the company is a winner. 2. Adjust for new information. Then, knowing that you are going to wait until the odds turn in your favor, pay scrupulous attention in the meantime to whatever the company does. Does management begin to act irresponsibly? Do the financial decisions begin to change? Has something happened to change the competitive landscape in which the business operates? If so, the probabilities will likely change. 3. Decide how much to invest. Out of all the funds you have available for investing in the market, what proportion should go to this particular purchase? Start with the Kelly formula, then adjust it downward, perhaps by half. 4. Wait for the best odds. The odds of success tip in your favor when you have a margin of safety. The more uncertain the situation, the greater margin you need. In the stock market, that safety margin is provided by a discounted price. When the company you like is selling at a price that is below its intrinsic value, which you have determined in the process of analyzing probabilities, that is your signal to act. It will be obvious, I'm sure, that this process is a continuous loop. As the circumstances change, the probabilities change. With new probabilities, you might need a new margin of safety, and so you have to adjust your sense of what constitutes the best odds. If this seems too difficult, think about the hundreds of small choices you make every time you drive your car, constantly adjusting your actions in response to the situation around you. The stakes are much higher, your safety and others, yet you make these changes almost without conscious thought. In comparison, keeping up with a few companies is a cakewalk. It is simply a matter of experience. It's not given to human beings to have such talent that they can just know everything about everything all the time, says Charlie, but it is given to human beings who work hard at it, who look and sift the world for a mispriced bet that they can occasionally find one. Furthermore, says Charlie, the wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds, and the rest of the time they don't. It's just that simple. The beauty of numbers. The world is full of people who love numbers, who view pure mathematics with the same reverence other people hold for classical music or beautifully crafted antique furniture. For them, talking of probability calculations is a joy unto itself. For everyone else, mathematics is simply a tool for getting things done or for increasing understanding, and like all tools, the mathematics in this chapter takes some getting used to. The more practice you have using it, the easier it becomes. You have to learn in a very usable way this elementary math and use it routinely in life, says Charlie. If you don't get this elementary but mildly unnatural mathematics of elementary probability into your repertoire, then you go through a long life like a one-legged man in an ass-kicking contest. You're giving a huge advantage to everybody else. Without question, Buffett's success is tied closely to numbers. One of the advantages of a fellow like Buffett, whom I've worked for all these years, confesses Charlie, is that he automatically thinks in terms of decision trees and the elementary math of permutations and combinations. Most people do not. It doesn't appear that the majority of investors are psychologically predisposed to thinking in multiple scenarios. We have a tendency to make decisions categorically while ignoring the probabilities. Thinking in probabilities is not impossible. It simply requires attacking the problem in a different manner. Furthermore, if your investing assumptions do not express statistical probabilities, it's likely your conclusions are emotionally based. As we will see in the next chapter, emotions, especially emotions about money, have a way of leading us in the wrong direction. But if you are able to teach yourself to think in probabilities, you are well on your way to being able to profit from your own lessons. It is not often the market prices Coca-Cola or any other outstanding businesses substantially below their intrinsic value. But when it does occur, you should be financially and psychologically prepared to bet big. In the meantime, you should continue to study stocks as businesses with the idea that one day the market will give you compelling odds on a good investment. Considering what it takes to be an inevitable, says Buffett, Charlie and I recognize we will never be able to come up with a nifty 50 or even a twinkling 20. To the inevitables in our portfolio, therefore, we add a few highly probables. Chapter 7. The Psychology of Investing. I came to the psychology of misjudgment almost against my will. I rejected it until I realized my attitude was costing me a lot of money. Charlie Munger. Psychology, the twists and turns of human behavior, has no place in the efficient market hypothesis and modern portfolio theory. According to its advocates, market efficiency occurs because investors, with the benefit of full information, instantly and rationally set prices. But since when are people rational about money? Few aspects of human existence are more emotion-laden than our relationship to money. With the possible exception of choosing a mate, we make more emotional, illogical decisions about financial matters than practically any other arena of our lives. Attempting to develop financial understanding without taking into account the human factor is like trying to navigate